Am I? Cool. Great. Let's get started. So the topic that I was given was on stock market basics. And only yesterday when I was preparing this presentation, usually I present on personal finance, and only when I was preparing this presentation yesterday, I realized that yesterday's session for you guys was personal finance. So what I'm going to do, because I didn't attend yesterday's session, if you don't mind, I will actually go through some basics anyway, just so I know that you know all of that, that I take it for granted. So I understand, obviously, all of you are young. I am assuming your average age is about 20 or so. So I will try and talk at that level. By all means, at the end, if you have any questions, just jump in and we'll tackle it that way. So now, I did a session only yesterday, day before yesterday, for IIT, one of the IIT colleges in India. And so they were asking a certain level of questions. So I've sort of aimed at that. As I said, was before you start investing, stock investing especially, you need to get your personal finance sorted. So I will cover that in a second. I will cover what are stocks and mutual funds. And then most importantly, that there is no best or right way about investing, and it really depends on your temperament. So let's get started. So very quickly, what is personal finance? Personal finance is basically after you earn money, how do you spend or save, grow, and protect your money? Now, the grow part is where the investment is. But it's very important that you actually have your protection in place, and you also obviously are spending less than what you earn, which is saving. But this is my framework. But when you go and look at all of the sort of personal finance sites, whether it's in India or globally, this is Yahoo or whatever, globally you see a whole bunch of laundry list of topics. So I just want to ensure that you understand that all of these, like for example, markets, mutual funds, commodities, they're all related to investing, which is what we're going to cover today. Now, the other thing to know about finance is that finance is not a science. Okay, so it's not like physics where there are laws like gravity. It is very much a social science, if you can call it science at all. And therefore, there are things that I'm going to say to you which I say are facts, but facts are basically things that the human society has agreed to call it as that. It's a textbook definition, but even textbooks change after a few decades. So just be aware that when someone says something, you might want to check whether they're actually referring to a fact, whether they're referring to a concept or a framework, or they're referring to an opinion. I will try to point out where it's a fact, where it's a concept, where it's an opinion, but you need to do that on your own every time you listen to someone talking about finance. So let's get started with the first concept. One is that when I talk about money, people say, oh, you must be good at math because money is all about numbers. Yes, it is, but actually it's more than about numbers. It is about psychology. Okay, so money is just a construct that humans have made up. And when we talk about markets, which we'll talk about, there's a lot, basically you're dealing with a whole bunch of other people around the world. And therefore you need to know psychology, definitely your own. And once you understand yourself, you realize that everybody else has their own sort of stories going on. And therefore you need to kind of take that into account. So now, what is your own sort of psychology? Starting with what your belief about money is. And this usually stems from your childhood. So I don't know about you, but most people, when they are sitting around the dinner table, your parents sort of either tell you things like, be careful, money doesn't grow on trees. Or it's only money, yeah, if more will come. So depending on which of these two extreme attitudes that you heard, you might be influenced by that belief. And that does manifest itself in the way you spend money, the way you buy and throw, the way you save, and all of that. That's one. And two is when you come of age. So around your age right now, whatever you've seen in the last sort of whenever you remember is what you believe about the market. So for example, if you have only seen a low inflationary environment, you may believe that that's the only way it is going to be. But your parents might have seen a high inflationary environment and they might believe something very different. Same thing about markets. Like right now, when everybody asks me about crypto, it's because in their lifetime, in the last 10 years, they've seen the crypto world growing and they believe in that. But you have to kind of question, hang on, why is this happening? Why is it happening now? And then trace that history back quite a long time. So most people don't like studying history, so they end up believing whatever they see when they come of age as a given. The second thing is that you have personalities. Everyone, I mean, just like we have normal personalities, you are different from me. Similarly, your investing style is different from mine. So that has an impact on what biases you have. Everyone has biases. They're usually grouped into either cognitive bias or a behavioral bias. And there's a couple of people who got Nobel Prizes for listing them. But what people don't realize is that we think that other people have biases, but somehow we don't. So we are not able to see our own biases. Just like you need a friend to point out what you are doing wrong, or when you are going to the gym or playing a sport, it's not like your coach needs to be better than you. He or she needs to be able to see you from a third person. Just like that, we all have biases, so we need someone else to point out what we're doing wrong. All these three things, by the way, is what I am trying to explore in a new podcast, which is called Lakshmi and Me. I have questionnaires about these on my website, so if you want to just have fun, go onto the moneyhunts.com and what wealth you own or what you want to build. Like, why do you want to invest at all? You want to invest because you want to make wealth, right? So question is equities, and if not, then how do you divide it? So a framework that I have, and I'm pointing it out, this is a framework, but it's a very useful framework. It's based on a mental accounting bias that everyone has. Okay, so I've used that concept and I've incorporated into how you think about money. So one sort of framework is that building wealth is like building a house. Now, what do you do when you want to build a house? The first thing you do is you imagine you are the architect. Now, when you're the architect, the first thing you need to know is your own capability. Are you capable of building a mud house, or are you capable of building a skyscraper? So same thing with, is your knowledge about investing very basic, or is your knowledge about investing very advanced? Accordingly, you should think about investing. Similarly, if you are an architect, you need to go and see the plot of land on which you're going to build a house. And that plot of land, is it near the sea, or is it on a mountain? Is there sun, or is there shadow? Is the soil rocky, or is it clayey? So things like that are basically the equivalent of, in the economic environment, do you have high inflation, low inflation? What is the GDP? Is it high? Is it low? Where are you in the business cycle? Is the market valuation high or low? All of these things you need to be aware of. And then also, when you have subcontractors with an architect, similarly, when you hire people in the industry, what you need to know is their capability and their vested interest. Now, once you have taken a recce of the land and your own capabilities, what do? You build a foundation. This is stuff you cannot afford to lose. So you hide this from everybody else under the ground. So this is money that you need to invest in cash or gold. Maybe a house if you really feel insecure about it. This is basically stuff that you cannot afford to lose. So you will probably not meet inflation, but low returns, but low risk. On top of that is when you build your growth pillars. This is the stuff that over the long term will build you wealth. Two pillars. One is your own skill set, and another one is a diversified portfolio of shares. And that's what we're going to talk about. The third one is Freedom Slab, which you don't have to worry about right now. This is more for people when you're retiring. And the fourth one is Fund Money Roof. Fund Money Roof is basically high risk, high return. So when you invest in one property or one stock or one business or one career, that's high risk, high return. And that's what most people who are young think, that they're geniuses and they can do this. but understand that that's high risk, high return. So now if you have 100 rupees or $100 or whatever it is, think about, forget the freedom slab. Think about these 3 building blocks: foundation, growth pillar, fund money roof. So now how would you divide these 3 up based on your intuition about, do you want low risk, medium risk, or high risk? What we are going to talk about today is medium risk, which is the growth pillars. Okay, but understand that you can do higher risk than that, and you can do lower risk than that, or higher return or lower return. Okay, so we are talking reasonably market return. Now, let's start with what is investing. Now, jumping directly into it. So what is investing? Investing is basically somebody has an idea, somebody has a business idea, and you happen to have excess capital right now. Okay, why do you have excess capital? Most people, when we are earning, we understand that the first 20 years of our lives, we don't earn because we are dependent on our parents. The next 40 years we earn, and then the last 20 years again, we don't earn. Typically, that's the way most human lives at this point are. So what you want to do is say, okay, when I'm earning, I need to save some money to be able to convert back. So I'll convert the excess energy that I have into money. I will invest it over the long term. And then when I'm retired, I will take it back. So now, where do I put that money? Like I said, I can either put it in cash or I can invest in a business. So now imagine my brother has a business idea. Say he wants to start a restaurant. He's come to me and said, sister, can I get some money from you? I said, okay, fine. Now, get or give, there's only 2 ways to invest. One is I can either lend him the money, in which case I want the money back. It could be for a 1-year period, 2-year, 5-year, 10-year, 30-year. But the point is, when I lend money, which is also called investing in debt, I definitely want my capital back, and we pre-decide what rate of interest we are going to charge. It can be linked to a floating rate or it can be a fixed rate, but the point is it's pre-decided. What you want to know when you're lending money is basically whether he has collateral, whether he has cash flow to meet the interest payment. Basically these 2 things. So basically what the question you ask is, what can go wrong with this picture? What can go wrong with this business? That's one way of investing. Another way of investing is investing in equities, which is basically you're now becoming a silent partner in his business. Silent partner means you have to be silent, okay? You cannot tell him how to run the business. You cannot tell him where to invest. You cannot tell him to pay me a dividend. You cannot want your money back at any time, okay? It is permanent capital. So what you're saying is, you start a restaurant, I will invest in you, but I trust you completely to go and make whatever business decision that you want. That's basically investing in equity. Now, think about what you would like to know about this restaurant, okay, or about the person who's running this restaurant. You'll want to know, okay, have you done your business plan? Like, where are you going to open it? What competitors are there? How many customers will there be? Where will you buy your produce? What will be the theme? All kinds of ideas. And then how much profit will you make? And then would you pay me a dividend or would you actually reinvest? So what is your ambition? Would you want to be a scale business or a lifestyle business? So these are questions that you would want to ask of any business. You can ask, you can make your judgment, you can decide to invest, but you cannot tell him what to do. So if you don't like what they tell you, you have to just back away and say, okay, I will not invest. You cannot tell them what to do. Okay, that's very, very important. So now let's take one step further. So when I said to you all of these things, what all things you'd want to sort of study, that's called fundamental analysis. What you're trying to get to by asking all these questions is simply, what will the business's future cash flows be in 1, 3, 5, 10 years, okay, depending on your time horizon. So you match your time horizon with what you're asking this person to share with you. So that's called fundamental analysis, which is basically you're treating the business as a whole. The business could be a restaurant, it could be a financial services company, it could be oil and gas, it could be a tech business, it could be anything. Okay, so that's what you're trying to ask this person. Now, the second step of the process is, Once you have figured out what the business cash flows are going to be, you then do a valuation and say, okay, what is that cash flow worth in today's dollars, which is basically a net present value calculation, okay, a DCF valuation. So that's called valuation analysis. So there are the two distinct steps of when you pick stocks. The third step is basically saying, okay, so say, for example, I've figured out valuation. How does it compare with current price? Okay, let me sort of jump in and tell you a little bit more. Fundamental analysis, like I said, how does the business generate revenue, which we talked about. The other thing is you have to say is the business, the profit consistent and sustainable? But you also do a Porter type analysis. Michael Porter had this sort of framework of looking at competitors, customers, suppliers, regulators. So you basically make a judgment of if this, I don't know, say Apple makes this iPhone, but how quickly can other phone companies come up with something similar? How will that affect the pricing? How will it affect, are there enough people who can pay Apple's phones prices? Things like that that you have to assess. That's all fine. That's all, but that could be that they have borrowed money and actually made that happen. So a lot of startups that you see in today's world are basically doing this on borrowed capital. So therefore, not only do you have to look at the business sort of return on assets, but you also then have to look at return on capital, which is basically after you take out the leverage and you say, okay, is the return on capital after paying back the interest, is it reasonable and sustainable? This is basically what you see on screen right now is basically what you do, how you do fundamental analysis. The second step, as I said, is valuation analysis, okay? So now, like I said, is you're basically doing a discounted cash flow on whatever projections you've come up with. Now, here's where people like me, I'm a CFA, we've been taught a whole bunch of different valuation methodologies, okay? We've been taught it's a DCF, and DCF could be on cash flows, it could be on dividends, it could be on all kinds of things. Similarly, we were also taught that, oh, there's multiples-based valuations or comparable valuations, which is basically like price to book or price to earnings. What I want you to understand is that all the multiples-based valuations, whether it's price to book, whether it's price to earnings or price to sales or whatever it is just a shortcut. Okay, it's just a shortcut, but basically you need to get to the DCF. So for example, if I say this phone company compares to that phone company, okay, but fine, this one is selling at 20 times earnings and that one is selling at 30 times earnings. I can say that, but it's eventually have to do a DCF on all the businesses. I may not do it every day because the cash flows don't change every day. So the price-based multiples are just a quick measure for just having to save time doing DCF. But once a year, twice a year, whenever the financials come out, you have to do DCF. Why is that? Because in the end, you are paying money to buy this investment. At some point, you need money back. Anything that does not pay you a dividend is not an asset. So I'm saying this again. Everything, all assets have to pay you cash flow at some point. Any business has to pay. So when people say, oh, but I'm buying for capital growth, it could be a property or it could be gold or it could be crypto. When they say I'm only buying this for capital growth, understand gold is a special case. We'll talk about that. But anything other than that, no, you're not buying it just for capital growth, because the capital growth always comes from cash flow. Okay, so you have to at some point expect that there will be cash flow. So if I say, for example, I want to buy a piece of land in the middle of Australia. Okay, fine, I can buy it. But if nobody's ever going to live there and rent it from me, then that piece of land is worth nothing. So all assets have to have cash flow at some point. Okay, gold is the only exception, and we'll talk about that. And then lastly, when you do the valuation, you then compare that to, you then do how many shares are outstanding in that business. And then you do a earnings per share and a price per share calculation. Earnings per share is basically figuring out, okay, how many shares, like how many ESOPs have they given out? what leverage they've taken, all of that fully adjusted. You say, okay, what is per share? What is the calculation that I have made? Like I said, then the next thing is comparison with the current price. So now when I say, so for example, going back to the restaurant business, say my brother did start that restaurant and he did really well, and his restaurant is doing really, really well. Okay, so he's got people are coming, all that sort of stuff. Now he wants to get out of the restaurant business and do something else. And he says, oh, okay, the revenue is say $10 a year. And he wants to sell the business for $100. And he's asking me, do you want to buy it off me? That's one option. Another option is there's another restaurant in the next street, which is not doing so well. They started off okay, but something happened, chef left, and maybe the building is not doing so well, or something happened, okay? So the restaurant is not doing well and it's shutting. But that person had invested a lot of money in making a really nice restaurant. And all the assets of the restaurant, so the tables and chairs and all the decor, say it could be sold, everything could be sold for $100. And he's asking me $50 if you want, buy it as is, because he needs to just get out of it ASAP. So the fire sale is happening, saying you can buy it for $50, but if you sell all the things individually over time, then you'll get $100 back. The question I want to ask you is, which one is a better investment? Not which one is a better restaurant, obviously the first one, but which one is a better investment? Now, this is the difference between value and growth. This is the two styles of buying stocks or buying businesses. One way is you are going after, oh, this restaurant is doing well. Also, for example, Apple as a company is doing extremely well, but the valuation is quite high. Another one is this company is right now hit by some short-term blip. They discovered a worm in their chocolate or something or the other, or some major disasters happened. You know that the company is going to survive. It's just a matter of short-term PR management or whatever it is, and they'll get over it, have a new CEO, and it'll be fine. Depending on what you're willing to pay for this versus this, you can say that you either have a growth style, which is the paying a high price for growth, or you have value style, which is basically paying a low price breakup valuation. Now that used to be the definition of value. Now it's been made much, much broader. And depending on who you ask, people define value very, very broadly. So when they say, oh, I'm a value investor, you have to ask them, okay, when you say value, what do you mean by that? Because the word has lost all its meaning. I want to say to you that neither is right or wrong. Both, because when you look at a market index, what they do is they rank it by a certain ratio. They draw a line in the middle, and then they basically say anything above the line, roughly, is value, and anything below the line is growth, or vice versa, depending on what ratios they've ranked it by. So by definition, if value and growth part of the same spectrum, then at any given point, one or the other will outperform and underperform. Okay, so therefore, I'm saying to you that both are technically correct. Both will make money over time, but from time to time, one will, depending on whether there's optimism or pessimism in the market, one or the other will outperform and one will underperform. So now the question is, what you have to decide is, okay, do I want to just buy and let it run? So Warren Buffett, who is one of the best investors in the world, used to be a value investor. In the 60s, last century, he used to say, okay, I will buy something and sell it for breakup valuation. And then he would achieve the target price. And then he would get his money back, sell it. And then he would have to invest again. And then again, and then again. And this could happen every year or every 2 years. So the problem with the value style is that you have to keep finding new ideas to invest in. And what he realized over time, when his tutor, Ben Graham, I think even when Ben Graham was alive, but after he met, especially after he met Charlie Munger, Warren Buffett realized that he was not able to find all these value stocks to keep reinvesting. And yet his portfolio was going bigger and bigger and bigger. So depending on how small or how big you are, you may not be able to find good reinvestment ideas. And therefore, a style will suit you better. So growth style will suit you better if you are a big investor and you don't want to buy a new idea every couple of years. Whereas if you're a small investor, you have hardly any money, you have all the time in the world, you can be a value investor. So what I'm saying is which one you pick will be dependent on a lot of things. It's your research capabilities, it's your size, it's your reinvestment, it's a whole bunch of things. Now, we were talking about single stock investing. With single stock investing, like I said, there's no right or wrong. And depending on time horizon, you might say, oh, in any given 1 year, I might have underperformed or I might have outperformed, but it's not over yet, right? You still have a long time horizon. You also could be wrong. You could be really wrong in that the company may have a risk that you did not see coming. Okay, it could have something as sinister as fraud, or it could simply have been hit like COVID hit. I mean, COVID hit the whole market, but I'm just thinking what else could be a bad, like for example, when the global financial crisis happened, that hit certain industries harder than others. So single stock investing has its risks. The way markets are, you don't get paid for that risk. And I'll explain that in a second. So what the market says is that you should diversify across stocks, sectors, geographies, themes. And the market, it's like going to a vegetable market and you see a whole bunch of vegetables and you come back, and if I ask you, okay, so were the prices up or down today for vegetables? And then you start telling me, oh well, the potatoes were up, but the eggplant was down and the chili was sideways and this one was this. And you start telling me all these prices and I'm saying, dude, I mean, like, just give me a sense. Was it up or was it down? So just like that, stock market indices are basically hypothetical baskets of shares where they take one stock of every stock ranked by descending order of size, which is called market cap, in a particular market. So in India, the top 500 stocks are called the BSE 500. In the US, the top 500 stocks are called the S&P 500. So just like that, in every market, if they rank the 100 or 200 stocks, depending on how big the market is, they give you basically 95 or 97% of the market cap. So that is the market. Okay, I'm putting in inverted commas because when people refer to was the market up and down, that's what they're referring to. There may well be 5,000 stocks, but the 500 is a bellwether for that market. So every market now has these market indices, which are usually by geography and size, like I said, market cap in that country, but they could also be by sector. So there could be a BFSI index, which is the banking and financial services. There could be a real estate index. There could be a oil and gas index, all of that. They all could also be by themes. There could be a GDP growth story. There could be a consumer story. There could be a exporters story. So there could be a bunch of themes. And ESG stands for environmental, social, and governance. So that's the various themes. So there are a lot of indices that are there in every market. Now, so the market, and it's not just in equities, but it's also there in all asset classes. So here is an example of a bunch of asset classes. So cash is considered the risk-free rate. And then there's on top of that, you can see there's sort of higher than that is treasuries, higher than that is bonds, higher than that is high yield bond, higher than that is equities. Okay, so there is a hierarchy of returns that are available. So equities as a whole should outperform all the other asset classes over time. Why is that? Because technically they have the highest risk, because you are basically taking residual business risk. Okay, but as a whole, now here is and this is going into advanced right now. All this time I've been hopefully talking very simple English, but let me just give you a sense of, in case some of you want to do finance as a study. It's quite fascinating. Basically, all asset classes are like Lego blocks. They're like building blocks. So they have a risk-free rate, which is basically at the bottom end, which is inflation, plus a little cash premium, which is a term premium. Okay, so cash has this returns. Then on top of that, there is a slightly above that is a bond premium. Bonds are usually for 3-year bonds, 5-year bonds, 10-year bonds. So a 10-year bond will have to give a higher return than a 90-day treasury, right? Because there's time value of money. But interestingly, that time value is only about 1.5% in most developed markets. So being aware of what that bond premium is quite important. Then on top of that, there's corporate bonds. Now here you're taking a default premium or a credit risk premium. Okay, so most corporate bonds will outperform most government bonds. Okay, again, over time. Then there's a thing called equity premium. So in the US, the equity premium has been in the past 100 odd years has been about 4%. In India, it's been closer to 7%. So there's this emerging market premium that India has over US equities of another 3%. Within the US market also, large cap stocks will have lower returns, small cap stocks have higher returns. So there's a thing called small cap premium. So what I'm saying is, over time, over the long run, it's like a Lego type thing where the higher the risk, the higher the return. And each of these premiums have been calculated for historical markets. That does not mean that they will always be the case going forward, but that gives you a sense of what it has been and therefore what it's likely to be, unless things are dramatically different. There's also a thing called private assets, so private equity or venture capital. People say, oh, private equity has higher return. Of course it has higher return, but being aware of why is it higher, it's because of the illiquidity premium. So private equity will have higher return than listed equity because of this illiquidity premium. Okay, so that's the fundamentals of stock markets. So then the question that people ask is, okay, well, that wasn't too hard. What I explained to you was very simple. What's so hard about it? I mean, you look at the business, you figure out what the cash flows are, you value it, and that's it. The problem is that everybody else has the same information, and everybody else would be as smart as you. In fact, probably smarter than you, has more experience. So if everyone has the same information and everyone is smart, well, not maybe everyone, but a bunch of people are smart, then why is it that you should outperform? So another basic truth is, when I said to you that, okay, so you figure out what the business cash flow is, and then you figure out the valuation. It's an assumption in finance textbooks that there is such a thing called intrinsic valuation. Okay, that's the intrinsic value. So if I am buying Apple's cash flows, if I'm predicting Apple's cash flows are so much, they will bring out iPhone 13 and they will do this and they will do that, and then they will have these much earnings. Therefore, I value their share price as this. Now you're assuming that that is such a thing as true valuation. And I'm saying to you, no, there is no such thing. It is whatever the whole world put together is willing to buy. So the stock market is basically one giant vegetable market where everyone goes and they have bid and offers. Okay, they basically, depending on how optimistic or pessimistic they're feeling about the future, the more optimistic you feel about the future and you think the world is going to be a benign economic environment and there's not going to be world wars and all that stuff, the more secure you feel, the more multiples you're willing to pay for a certain cash flow. So the more certain the cash flow, the more you're willing to pay multiple. The less certain you feel about the future, the less multiples you're willing to pay. The point though is that it's the collective psychology of the market any given day. And any given day, there's so many things happening in the world that everything has an impact, even the weather. If it's just bad weather, that will have an impact on the share market in that country or in the US market. So I'm saying to you that the reason stock investing is hard is because it is basically about greed and fear. It's about the human brain, and that has not changed in thousands of years. What has changed is the flow of information, how quickly you get information available to you. So the olden days, the financial statements would come out on paper. So when they would come out, you'd have to read it, you have to put it into no spreadsheet, but in with a calculator, figure out how to value it, all that. Now, all of that is instant. So the reason markets might be getting more volatile is because things are getting much more instantly incorporated. The other thing is that market participants, everyone is playing a different game. By that, I mean, everyone has a different time horizon. So I could be investing for the next 20 years. You could be investing for the next 20 minutes. So we might be bidding and offering on the same stock. Your time horizon is 20 minutes. So you might just say, oh, there's momentum in this stock. Let me just buy it and I'll sell it after 20 minutes. Whereas I might be saying, yeah, koi baat nahi, it doesn't matter. I am buying it for the next 20 years anyway, so I will buy it. So any given time, different market participants are doing different things. So you have to respect that if you think that you are the smart one, why is this other dumb person selling this stock to you at a certain price? It may well be that you are the person who's being played. Okay, so just remember that. Second thing is that something as benign as inflation has been a given over the last 30 years. Inflation has been coming down, which has had a valuation effect of pumping up the price of assets over the last 30 years, pretty much the whole time you guys have been alive. My whole career. But now, if you go and read the papers, you'll see that people are starting to talk about inflation perhaps going up, which means that there's a very different inflationary environment going forward than what has been over the last 30 years. So if things are hard, then just like they're experts in a whole bunch of other industries, are they experts in financial services? Of course they are. They're called fund managers. So you can actually outsource your investing to them, and they're called mutual funds. So what are mutual funds? They're basically a trust structure where you can invest into a diversified portfolio of stocks. And the idea is that they charge you a fee, and depending on whether they're trying to track the index, if they're tracking the index, they call a passive fund. If they're trying to outperform the index, the market index, they're called an active fund. So depending on whether they're trying to outperform or track, they charge different levels of fees. So passive funds, they're called index funds or passive funds. Some of them themselves are listed on the stock exchange. They're called exchange traded funds. Most of them are passive. Now, so the question is, okay, well, you think you're smart and you can select an active mutual fund, okay? The question I have there is, just like selecting stocks may seem easy, but it's not. Just like that, selecting mutual funds may seem easy, but maybe it's not. So the three questions I ask is, can it be done? Is it done? And can I do it? So can it be done is basically a function of, are the funds' performance over time variable enough for you to even make an effort? So if there are only two funds in the market, if there were only two stocks in the market and both of them did 10%, whether you picked A or B, frankly, wouldn't have mattered. Similarly, if there were only two funds in the market, if they picked A or B, it wouldn't have mattered. So here, this chart is of large cap Indian equities, and the dotted lines show you the dispersion of returns between the top and the bottom quartile of mutual funds. So 10 years ago, the dispersion was quite high, up sort of 10%. So positive 10% to minus 10%. So 20% difference over 3-year rolling period, which was very high. But you can see over time, over the last 10 years, it's got compressed. It became really compressed here. And then again, I mean, it's reasonably compressed. I mean, it's reasonable. It's up 2.5% and minus about 2%. So it's only about 4% per annum. Now that is very tight, which means that if you are wrong on your fund selection, then you're underperformed by 2-3% or you outperform by 2-3%. So it's not really a huge, I mean, 2-3% is reasonable, by the way. Institutional investor may still want to attempt to do this. But a retail investor might say, well, hang on, can I actually even select the funds? What do I know about selecting the funds? And that's where I'm telling you it is hard. It's something I've done for a living for the last 25 years. And it's something that I'm launching in India as a research service. Don't take it for granted that it's easy. It's called Manager Alpha. And again, 10 years ago, 20 years ago, it used to be very simple to select mutual funds. Now, with more CFAs and more professional investors, we are getting smarter and smarter about doing these smart beta ETFs. Don't worry about it. I won't explain unless there's questions about it. But basically the manager alpha, which is how mutual funds can actually outperform through skill, is getting harder and harder and harder. Okay. So question is, then you might say, well, actually, after doing all this, Hansi, all you're saying to me is that stock investing, I mean, it can be done, but it's hard. Mutual fund investing can be done, but it's hard. Then what is it that you're asking me to do? The answer is, if you attending today's session, I'm assuming you are a beginner. And if you want to begin, I thoroughly recommend that you should begin investing in your 20s. So what you should do is start investing with buying an equity ETF. It's passive, it's cheap, it will give you instant exposure, and you can let it run for the next 20, 30 years. So start getting a feel for the market, respect for the market by buying an equity ETF, the broadest equity ETF you can find in your market. Buy that first. Then start investing in 2 or 3 stocks, maybe 1 or 2 large cap stocks, 1 or 2 small cap stocks, and see how they behave, how volatile they are, how soon information comes out, how it comes out, how analysts talk about it. All of these things are skill sets that you have to develop over time. Stock investing is the only profession that I know where someone with no experience, no qualification can do much better than someone with experience and qualifications. But it's like a meditation thing. It's a really enjoyable sort of profession or game or pursuit if you follow it, but you have to keep learning, because markets will change. There's no one formula that will work for the rest of your life. So I would suggest to you, start simple, buy an equity ETF, and then start practicing with a few stocks. The only 3 ways you can outperform is if you have better information, better analysis, or better behavior. And I can tell you, unlikely you'll have better information or analysis when there's so many CFAs around. Chances are you'll have better behavior, because if people are in the market, they tend to be itchy. They want to do something. Whereas people who are out of the market may just have the patience to buy and forget and let it compound. The market will do all the work for you if you have the right sort of patience. And lastly, I'll say is, remember why you are investing to start with. If you are making this your profession, then by all means have fun. But if you are simply investing to build wealth because you have other pursuits in life, you want to be a rock star or whatever else you want to be, then don't waste your time in doing things that are not your comparative advantage. On that note, I will end, and I will simply ask you that if you like this, hopefully you can share and ask questions on any of the social media. My handle is The Money Hans, and on this point, I will stop and take questions. Can I hand it back to you, Aditi?
Yes, ma'am. We have one question. What is equity ETF?
So ETF stands for Exchange Traded Fund. So it's a fund. It's like a mutual fund that tracks the particular index. So in India, the best known index is the Nifty 50. Okay, it's 50 largest stocks in India. So the Nifty 50 ETF tracks the performance of that index. So basically, you are buying one share, but that one share it gives you instant exposure of 50 stocks. So it's the simplest way of starting to invest. Make sense?
Yeah. Any more questions? Does anyone have any questions? Please drop it in the chat box.
Did it make sense? Did it make sense? Aditi, I should ask you. So did it make sense? So okay, the question is, how do I start investing in ETF? Okay, so depending on where you are, I don't know whether you're in Sri Lanka or India, but basically you go and open an account with a broker. Okay, so ETFs are listed on the stock exchange. So you go and open an account with a broker, and you then buy the ETF. I don't know what the symbol is for the Sri Lankan market. In India, like I said, it's the Nifty ETF. You can literally search for it. I've forgotten the symbol name actually, but in any app, you can just buy it. This is just Google Nifty ETF or Google. Firstly, I need to figure out what the name of the Sri Lankan index is. I should have done that. And then there must be an ETF on it. Okay, so there's some questions coming in. Do you want to moderate, Aditya? Should I read them?
As you wish, ma'am.
No, go ahead, read them out.
Okay. So next question is, which best funds to invest in SIP?
Okay, so there is no such thing as best funds. Okay, that's what I'm trying to tell you. The whole presentation was there's no one such thing, because any fund, if it's active, will outperform and underperform over time. You have to pick which fund, and your market is different from mine. You have to do some research on it. Hence, I'm telling you, if you don't know what you're doing, just buy the ETF. Don't try and pick active fund. Pick a passive ETF on your market. And you can buy, so SIPs are systematic investment plans, which is basically you put in a dollar amount or a rupee amount every month on the same day into that fund. So what you do is in your market, you find the index fund on the equity market. So if the Nifty 50 is the index, you find the index fund that is the cheapest and you buy an SIP into that. How can you do it? I mean, like I said, your advisor or your, I don't know how the Sri Lankan market works, but in India, you can actually go to any of the apps, Zerodha or any of the apps, broking or whatever, and just buy it cheaply with no expenses.
Okay, ma'am, one question from me. Which app is the best for investment? Like those many apps are sprouting up in these days.
They are. So depending on what you want. Okay. So again, the question that I don't understand when people say, what is the best? Best for what? Best for what? I mean, what is the objective, right? Understand this. You have to have an aim in mind. It's like saying, what is the best career in the world? What do you want to do in life? I mean, you have to figure out now. So best app for buying is different from best app for reporting, best app for whatever. So in India, Zerodha has become a popular one. I personally have it just because everyone was talking about it, but I found it very hard to use. So I just got it just for that. But I could have easily bought from one of the broking like ICICI or whatever. The problem is that obviously Zerodha doesn't charge because they called a discount broker. So I went with that. Now, other apps do more than just facilitate buying and selling. They start giving you suggestions or advice. That's where things get complicated because they start telling you, oh, you should buy a portfolio of stocks. We'll give you a small case or a basket, and this is this theme or that sector, or you should believe in this theory. They start giving you all of this, what looks like an easy concept, but I'm telling you what I just spent the last hour trying to explain to you, that if it was that simple, everyone would be doing it. It's not that simple. So at the moment when you're just starting out, buy it on the broadest possible market index. Okay? Buy that, see how it grows a little bit, then start on a satellite basis, start buying the other ones based on what you're reading. Okay, so don't buy it unless you're interested and are willing to spend time and interest studying it. So some apps, like I said, do give you these thematic portfolios. There's no research to say that one theme will outperform another theme. You might say, oh, I want to bet on the Indian healthcare system, so let me buy a healthcare theme. Okay, well, that's your prerogative, but that does not mean that it will outperform everything else. That's based on your theory. You must have some sort of insight thinking about why that's the case. Does that make sense? So every investor has to have a theory about why they're doing it, how much the time horizon is. When, for example, one theme by definition can be more volatile than the broad market. So when the market goes down 5%, then one theme could have gone down by 40%. Are you willing to tolerate 40% downfall? 100 rupees invested, it's gone down 40%. How will you feel? So I'm saying to you, it's every time you go anything smaller than the market index, you are taking some risk. And you should take it, but only after you've done your homework. Yeah?
Fair enough, ma'am. And moving ahead, there's one more question is, wait a second. Is ETF more expensive than regular stocks?
Regular stocks are not expensive. You don't pay a fee for stocks, right? You only pay the brokerage. And if you buy through a discount broker, you don't pay brokerage at all. So you're buying the stock as a stock price, whatever the bid offer is on the stock exchange. A fund charges a fee to manage it. Okay, and the fee is paid to the custodian, to the registrar, to the fund manager. If it is an ETF that is tracking the index, the fee is only 0.1%. If it is an active mutual fund, it is 2%. So it is 200 basis points as opposed to 10 basis points. So it can, if they're trying to outperform, they will charge a higher fee. If they're trying to track, they will charge a lower fee. I'm saying to you, start with buying the passive ETF or index fund at 0.1% at a low fee while you're still learning. Okay, and then think about how to select funds. Today, I can't teach you how to select funds. Okay, even if I taught you everything I know, you need data to be able to select funds. Just like in stocks also, I can teach you how to, but you need to have data to do it, right? I can't tell you which stocks to buy. So all of these things require a bit of time and effort. Because I wasn't sure what you guys want to do. If you want to do a career in stock investing, then that's different. But if you want to be doctors and lawyers and rock stars, then this might be a very small part of your life. Then you should just buy the ETF and be done with it. Make sense?
Yeah. And we have more questions. Is it possible to buy foreign shares?
Yes, it's possible. Again, depends on the tax and the ease and capital flow. So in India, for example, there is a concept, LRS, Liberalized Foreign Remittance Scheme. So they have a certain limit. So you can buy through overseas apps. You can buy through Indian apps that buy overseas. But now some of them are launching on this International Finance Service Center, IFSC in Gujarat. The point is, yes, the answer is yes, you can buy foreign shares, but I don't know the laws in Sri Lanka. So I don't know if they have capital controls and how that works. So you have to look it up. But yes, most countries allow some amount of foreign stock buying.
And what is the difference in active and passive funds?
Passive fund tracks the index. Active fund tries to outperform the index. So if you think the GDP of India is going to do, say, 5% inflation and another 7% real, so say 12%, okay? The market is likely to do around 12, 13, 14%, 1 or 2% higher than GDP, okay? That's the long-term expectation from the market. Now, if you want to do higher than that, you go into an active fund. But like I said, the active fund has to have a philosophy and a capability to be able to outperform the index. And you have to pick that fund. There are 45 AMCs in India, okay? And they have 1,000 funds. So you have to decide which active fund will be able to outperform. Some will outperform, some will underperform. So if now you are saying, Acha, I want to invest in the long term and I want to make 15% returns, which is what the Indian equity market was likely to give me. Now, if I pick an active fund and I'm wrong, and that fund underperforms, so I have done my math, I will retire with this much money, assuming 15% return. And this fund has underperformed and only given me 10%. I will not meet my goals. And I've paid 2% active fees for the privilege of underperforming. You understand the risk? So in an active fund, you run the risk of paying fees and underperforming. Of course, paying fees and outperforming, but for that, you need to know how to pick funds. And I can't teach you that in one session because you need research, you need data. Okay, so even if I were to tell you today, it would not be relevant tomorrow. So you either get a good financial advisor who has that research. But my suggestion to you is just buy a passive fund. A passive fund or index fund means the same thing. Passive index means the same thing. All they're doing is tracking the index, the market index. Buy one of those cheaply, and you are guaranteed to go and at least get the market return. And then over time, if you are interested, then start picking active funds or active stocks. Make sense?
Yeah. And one more question, how to pick any stock, or what are the factors to look to pick a stock?
Yeah, I don't know whether you guys are taking this seriously or not, because I just spent the last hour saying there is no one right thing. Guys,
Yeah, you need research.
Yes, you have to do research. You have to figure out the business prospects. Then you have to do a valuation. There's so many factors. There's no one thing. I don't know what I'm either I've done a bad job of doing this session, or just asking questions for the sake of asking. I just spent the last hour saying, okay, you have to pick a stock based on prospects and then valuation. And then you have to figure out what do you know that the market doesn't know. All of these things is what active stock picking is about.
Okay. So there's one more question. Is IQ option a suitable app for trading?
What?
Is IQ option a suitable app for trading?
But why would you want to trade? Okay, so hang on. You've come to a beginner session to learn about investing.
Yeah.
Okay, which means you don't know anything about investing. That's why you've spent your time coming to a session. So if you don't know about investing, how can you be a trader? A trader is someone who thinks they know what they're doing over the short term. Investing, even if you are no clue about investing, you buy something and you let it run for the long run, you will make money. Trader has to know what they're doing in the short term. Okay, so I'm saying to you that if you're coming to a beginner session, that means you don't know anything about the stock market. Do not ask someone like me, how can you start trading? Don't, okay? So I will not say anything on trading. If you want to learn trading, please go and do a proper course in trading. And even after doing courses, people lose money. Okay, so the one thing I will hopefully take away from today is have a healthy respect for the market. Markets have a way of greed and fear and whatever. So people who make short-term money in the last 12 months, a lot of kids have made money and they think they're geniuses. If they have taken the money out of the market, great. But if you stay in long enough, it's like a casino. You think one day you are winning, okay, and you're stuck, you're addicted to the slot machine. You will lose, okay? The casino will always win. The house will always win, okay? So trading is like that. It's like you walked into a casino. They will give you some good days of good profits, and then you'll get sucked in and most likely lose your money. Okay, so do not come to me for trading advice. Please go and do another course on trading.
Okay. So here's one more. Why Bank Nifty is more volatile than Nifty?
Because banks are only X% of the overall. So the Indian economy, or any economy for that matter, is made up of many sectors. Okay, there's banks, there's materials, oil and gas, there's manufacturing, there's real estate, there's FMCG, there's consumer, there's a whole bunch of things, right? These many, diversified. It's like a diversified buffet of food. Then you pick one of them, banks. Banks is only, depending on which market, could be between 20 and 40%, or rather financial services, banks and financial services combined, BFSI, depending on which market, can be 20 to 40% of the market. Okay, in India, it's quite high as well. The point is, when you then pick that, it's like I said to you about pharma. Okay, it's a theme. You can pick a sector, but that one sector, like one day might be interest rates have gone up or down. So that one sector will get impacted more by that one decision than everything else. So everything, it's a like I said, a buffet. So one sector may go up, one sector may go down on any given day. So the combination by always will be less volatile than any component part. like anything, right? It's like, just trying to think of what a good example would be. It's like when you have multiple players or multiple food on a thing, okay? Any given thing will always be more volatile than the combination, right? That's just common sense. In finance, there's a concept called correlation. Because these sectors are low correlation with each other, therefore the combination will always be less volatile.
Okay, and here's the last question and the most interesting one. What's your take on cryptocurrency, and is it more lucrative than stocks?
I thought I made it very, very clear that I'm not going to talk about crypto. Because crypto, in my view, is not a currency. Currency is what the governments issue, and governments are considering their own digital currencies. Crypto for currency, it has to be stable, and it hasn't been stable. The one thing I will also say is what I said for the last hour is that for it to be an asset, income. So just think about how would you value crypto? What is the income stream? I would leave it at that. I would rather ask a counter question. Think about how to value it. And I don't think anybody in the world right now knows how to value it, which is why it's going up and down so much, so volatile.
Yeah. And one more question. What percentage of income should one invest?
You should save on average about 30% of your income throughout your life. Sometimes you'll be able to save only, you'll be able to save 50%, depending on when you are in your life. If you keep it 30% invested to spending less than what you earn, you'll be fine. Take the 30% and invest it in 3 buckets: short term, medium term, long term. Short term is in cash, emergency cash. So cash, fixed deposits and cash and gold and whatever. Medium term, in a balanced portfolio. Long term in equities or in your own business. Okay, so you have to decide what your short, medium, long term are, depending on how much risk you can take. And that depends on how much of a backup plan you have. If you are living with your parents and you have a house to live in, you will behave differently. I, as a 19-year-old, did not have that. So my risk profile was very different. For my whole life, I had to be played safe because I didn't have a house to fall back on. So everyone will be different depending on what their overall situation is. That's what I'm saying to you. Think of that house, okay? Think about what is in that foundation. Do you have 6 months of expenses in your bank account? Or do you have parents that can fund you or friends that can fund you? Then you will behave very differently to someone who doesn't have that, right? So every situation is different. Think about it in that house term. But 30%, if you save and invest, you should be fine.
Okay. But there's one question that the person really loves to invest, but I want the answer for this question. Is your life
Me?
glamorous?
How is it glamorous?
Yeah.
Sorry, I didn't get the question. What?
That person really loves to invest, but wants your answer that is your life glamorous? Like, is trying to ask you about what kind of a lifestyle are you having as a CFA, as a investing stuff.
Okay, so is my professional life glamorous? Is that what you're asking?
Yeah.
Oh wow. Okay. My life hasn't been. It depends on what you do with it. CFA is just a qualification. So you can, with the same qualification, you can become a doctor. Okay. So you become medicine, you qualify as a doctor. You can choose to be a local general practitioner, GP. You can choose to work in a hospital. You can choose to start your own hospital, make a business out of it. Okay, so you have 3 different ways of leveraging what you've learned. Same with CFA. CFA is the input. It's up to me to decide what my output is. I chose to work as an investment consultant, research analyst, investment consultant in a very institutional setting. Investing is never glamorous, really, unless you happen to be. See, okay, now here's the other thing. What is glamorous? When you see a high-profile investor appearing on television, okay, you may say, "Oh my God, this person is very glamorous." Yeah, well, actually, you know what they're doing? They have bought the stock. Okay, now when you buy a stock, by definition, you think it's undervalued. Remember that restaurant I said, okay, it's undervalued, you buy that stock. Okay, now the problem is for you to be able to sell it, you need the price to come up to what you think it's worth. Problem is nobody else is recognizing it. So what do? You go on television and you tell the whole world, this stock is very good. Okay, go and buy it. What this person has done has already bought the stock. And then he's telling everybody else, please buy it, so that I can go and sell it when you are buying it. That's what fund managers are doing when they go on television. Okay, so that's not glamorous. It's part of their job to convince the market, I have seen a rough diamond, and now I want you to see it. That's what they're doing. Okay, so that's, to me, it's not wrong. I think it's wrong if they don't tell you that they bought it and they will sell it. Okay, so it's wrong for them to do the opposite of what they're telling you to do. Okay, but they do it. Okay, so you need to figure out your own thing. That's why you shouldn't believe anything you see on television. In terms of growth, I know stars in lifting. I can tell you that even no film star, I know a bunch of them, life is not as glamorous. I make videos, okay? It's like 50 takes, least glamorous thing ever. So what you see is the end result of a lot of hard work. And that goes for any career, okay? Whether it's a sports person, whether it's an actor, whether it's a, so right now, an investor may make a lot of money, a startup investor make, but so many hours and years have gone into analyzing and studying the market and doing the hard work and all of that stuff. So everything has things that you don't see. You only see the end result.
Okay, here's the last question. Is there interest-free investments?
What does that mean? Interest-free investments in terms of I don't get interest or I don't have to pay interest? I don't understand.
Okay.
So is this like a Sharia thing you're asking? As in, because Sharia doesn't allow interest, are there Sharia investments? Is that what you're asking? Or is it, I'm not clear what you're asking.
Okay. So that's all then.
Okay, so now tell me, was it worth it? Okay, did people understand the basics of stock market? Yes or no? I'm a little bit worried about the questions. Okay, so I'm a little bit worried. Doing a section like this is hard because of this. Go on.
It was worth it.
Yeah, so you understand?
Yeah, we basically did.
Treat it like a business. You have to think about a business, then you have to value it, then you have to figure out, okay, what do I know that other people don't know? Okay, markets are fascinating. Okay, obviously people like me will say that. Everyone who chooses any career will love their own career. Okay, I will say to you that finance is fascinating. Why? Because any industry, okay, whether it's actor or sports or health or whatever, every industry, even a beggar on the street has to deal with money. I happen to spend my whole career in money. I find it fascinating. Okay, it teaches you more about human psychology. It teaches you, when you read a fiction book, some people say, science says that when you read a fiction book, you become a more compassionate person because you start to understand how the character is thinking. I'm saying to you that let me see what they're doing with their money and I can tell you what they're thinking, what their outlook in life is. So I find finance insanely interesting because of the insight into human psychology. But that's me. So whether you like it or not, you have to deal with money. You have to invest because you will get old one day and you need that money. So what I'm saying to you is you can choose to spend as little time or as much time in investing as you wish. You can change that over time. So if you want to invest very little time, buy an ETF. Let's start today. If nothing else, if I've given you, all of you go and find the app or broker and buy an ETF on the broadest index in your market, okay? And let it compound over the long run. One day you will thank me. Today's Teacher's Day, apparently, by the way. So if I taught you this, please do this, okay? If you like investing,
Happy Teachers Day.
something else. Yeah, thank you. If you like investing, do something else, but at least this much you do. For me, I'm asking you, all of you, please go and buy 1,000 rupees or something. Just buy and let it run, and hopefully never sell it. Hopefully in 20 years time, you'll say, wow, this money has grown so much. And it's because one day I listened to this crazy woman who appeared on Teacher's Day and said, buy this 1,000 rupees worth of investment. Okay.
Okay. So thank you, ma'am. It was really an amazing session. And I think so everyone is going to remember it as the think of money more like a psychology, more than, not less than anything, but think of it as a psychology. And thank you. I express my heartfelt gratitude for gracing this event amidst all your hectic schedule. And of course, I feel most of them are going to invest in ETFs. And one day we will definitely ping you in your LinkedIn or whatever they feel so. And I also thank President of Rotaract Club of Sri Lanka, Mr. Induvara Palagama, and Rotaract Club of PCE Nagpur, Kush Dhande, for their constant support. Also, I think International Services Committee from both the countries for arranging such an event. And last and not the least, I thank all the Rotaractors present here and all those who are directly or indirectly have made this event a success. Thank you everyone.
Thank you, and I look forward to all of you. I'll send you, Aditya, I'll send you a feedback thing. Please leave a comment, and all of you if I also on one more favor to ask, can you, if you think anyone in your circle needs personal finance sort of education, I don't do one-on-one, but there's a whole channel with 100 videos, okay, 2-minute videos. So please go and watch, check it out and share it with your family and friends. Yeah.
Yes,
Guys,
sure.
before we end the session, shall we turn on our cameras and take a quick picture?
Yeah, sure. You done?
No, we'll take the picture, first picture in 3, 2, 1.
Yay. Okay, send me the picture, yeah?
Yeah, sure.
Actually, I can probably do it. Gallery. But it's still, send me the picture, yeah?
Yes, sure.
Great. Thank you. Thank you. Have a good rest of the Sunday.
Thank you, ma'am.
Ma'am.
Bye.
Thank you so much.
Bye.
Bye.